All right, I'll call the meeting to order. The Olivet Pension Meeting. Board. Thank you. All right, let's, I don't think we don't need roll call, do we?
Yes, go ahead and do a roll call. Josephine Conway. We have Ted Isaac.
Yes, here, present.
Brooke Reed, Laura. And we just have Mike, are you here? Good. And it looks like Greg might be just joining right now. I see two participants. Good. Do we want to join him as, we'll join him as promote to panelist. Come on.
Aren't you in charge?
You got peer pressure by Alan into joining. Okay.
I don't know. I just saw that there. Yeah, I know. It's medicine. It's called a headset prescription.
Wonderful. How are you?
It's been a crazy day.
All right, so let's begin this. Since we're here, we can get going. Do I have a motion to approve the minutes from last meeting? Alan moves. Anybody?
Second.
Mike seconds. Any discussion or changes? All in favor? Anybody opposed? Awesome. All right. Let's go to you guys. You are the show.
Let's go on.
Yes, well. Till we get rid of principal and.
In due time.
Yeah.
Good evening, everyone, and let the record show that we are without ties per direction from our chairman. So thank you.
And without a razor too, I see.
Yes, well, that's my thing. That's my look. Okay. So we have the third quarter performance update, and then a little bit of a rebalance, and then a discussion on our fee. So upfront is just the market environment. We never go through that.
Yes.
What's kind of going on in the world. So if you go to exhibit 1, page 1, as always, just for your minutes, everybody's in compliance, no issues with any of the teams, strategies, or organizations that you're working with. Let's jump ahead to page 4 and 5. Take a look at the overall allocation at the end of the quarter, as well as the market values. So if you jump over about 4 columns from the right, the ending market value at the end of the quarter was 23,343,462. As always, fixed income is less than the target because you guys pulled from that for benefits throughout the quarter. So we'll be discussing that again. But kind of going on the list there, a little bit overweight US equities, a little bit overweight non-US. Real estate is a little under, and then private equity is a little over, and just a tiny bit of cash at the end of the quarter. Let's jump maybe to page 8, looking at the market value history. And as always, you have different kind of starting points in time. Most recently, the quarter, year to date, all the way going back to 10 years ago, what the beginning market value was at all those various periods. Net cash flow. So all of those are negative. More money is coming out of the plan versus coming in. No surprises. And then what was the net investment change during those various time periods? So for the quarter, you'll see the fund made about a little over 1.2 million. And then year to date, up about 2.3 million or so. And you can obviously follow along on those on there. So obviously, as you'll see in performance, August and September were kind of repeats of each other. The first few days we saw sell-offs due to some macro information coming out and just general concerns. And then the rest of the month was just basically obviously catching up for that, and then getting some strong positive returns, and then some. So
I have just a quick question. The
Yes.
negative cash flow is a direct result of paying pension benefits?
yes, more money out versus contributions.
And is there a plan or recommendation to reverse that trend?
That is not our call.
No, I will.
Okay.
Sorry, I turned that off on that one.
Yeah.
No, there's nothing you can do. I mean, the pension benefits are the pension benefits, and as
Mhm.
people retire and there's not a lot of control we can have on that. That's always our concern, or my concern. I don't want to speak for everybody, but
Because
be-
it's-
because he projects the return at, I think it's 8 or 8.5% when they do their actuarial numbers. And what's that?
Should be less.
Is it less?
Your assumed rate of return is 7.
7.
It's currently
Okay,
7.
still, it's pretty.
Changes through time, but.
Yeah,
seven.
it's pretty high. And I mean, we have to do really, really well here.
Mhm.
And I think that's partly why we're fairly aggressive at 70% equities, because we need to get a return. Yeah, otherwise, I mean, you see, we've done really well. I mean, your investment change over 10 years is up $15 million, but almost 11's gone out.
Right.
Yeah.
Which is long-term unsustainable.
It's hard. Yeah,
Yeah,
if we
it's
have,
hard.
if we have a decade like the first 10 years of this
Yeah.
century, we
The
will be,
lost, no, the lost decade, 2000, 2009,
yeah,
equities,
we'll be in big trouble.
equities were challenging.
You're 100% right on target.
Okay.
Yes.
Yeah, so but you're not alone. This is a
Right.
mature plan. This is kind of a lot of the discussions out there.
Why? Yeah. No.
They have the same problems that we do, but we are.
You have some unique things here.
Yeah.
Thank you.
Yes. So if we look at kind of the actual performance, maybe if I can get your attention to page 12. And these are all, and once again, these are all net of fees. So any of the, any of the fees for any of the managers are taken out. So you're actually seeing what they do against their benchmarks. So as I mentioned, September, good rebound, 1.7 for the quarter, it was up 5.5. Benchmark was 5.8, so trailed that a little bit. And then year to date, up 11% versus 11.1. From a fixed income standpoint, for the quarter, you see you're at 4.5 versus 5.2. So trailing a little bit there. Overall, longer term, you look at those returns, obviously they're, to Ted's point, anemic, you go 10 years, 2.7%, the benchmark was 1.8. So from a relative standpoint, obviously did quite well, but there was no yield to get in this space. Obviously rates are higher for now. You look at that 1-year number, with interest rates coming down, you got some nice tailwinds from that. Recently, October, which isn't included in here, we saw rates back up a little bit, so we're starting to see a little bit negative returns in October. But that's any dollar you put in there trying to get towards your 7%, obviously is going to fall short, but you have that in there as diversifier for part of the portfolio, so that when you have a 2000 2009, you're not totally in the tank.
How's the year to date beating the benchmark when everything else below it is like at or below the benchmark?
I think
Like the year to date 5.6% is the fixed income composite versus
Well,
the
you do have your principal high yield and Aristotle Pacific, your floating rate, kind of lifting that up.
but none of them are beating their benchmark. How's it?
the benchmark is just the ag.
Okay.
For fixed income, so
It's not a blended benchmark of all these combined. is what
No.
you're saying.
That's okay.
That's
Yeah.
what it
Yeah,
is.
yeah.
Okay.
so yeah, looking at your fixed income managers principal, which is the core, it's nothing sexy there, but it's doing what you need to do, and obviously that's where you pay your bills out of. So each month there's funds flowing out of that. Core plus, you see a little bit underperformance recently, actually compared to core, but we are starting to see a little bit of better performance from core plus. And going back in time, you see got a little bit of a bump from having some of those funds in core plus. High yield from principal, they've underperformed through time. This is one of the ones, obviously this is more on kind of your probably to-do list. This is one of the ones we said, maybe in the future, there's other options out there that, we have done better through time, but at the end of the day, you need to have assets still at principal. So it's kind of more of a future to do. And then Aristotle Pacific. So that was September of 2022. That was one of the first time that we were able to pull money out into a different fixed income. And obviously you see kind of how that's played out, and that's been additive in the portfolio through time. US equities, page 13. Good quarter for the lineup, 7.3 versus 6.2. Remember, back in the spring, we kind of streamlined things and made a couple tweaks. You took a little bit of some of the bets off, kind of the overweights that you had and kind of reduced those. So obviously you're not going to get 110 basis points every quarter, of course, but obviously that's a good start to this lineup. So obviously you have the Vanguard 500, that's the index fund, extremely low fees for the S&P 500. Mid cap, remember you had a growth and you had a value, so let's just combine that and not make this overly complicated. You actually saw mid cap, do quite well for the quarter. And then on the small cap side of things, initially you were focused on the Russell 2000. We had kind of a discussion on kind of the historical returns of the S&P small cap 600 versus the Russell 2000. Historically, obviously every quarter and year will be different, but historically the S&P 600, which has it's a higher quality bias, the Russell 2000, I think 30 to 40% of those companies don't make money. This is not going to be in that camp on there. So obviously there'll be time periods where companies that don't make money do better, but obviously it's proven out through time as a kind of a better mousetrap for small cap. Page 14, non-US. Obviously good month, good quarter. Non-US, obviously it was quite a interesting quarter, an interesting month in September for China. But you can see for 3 months, 8.3 versus 7.7. And then Vanguard, obviously you have the total stock index there. That's getting you those returns. You have the small cap. So it's good to see small cap, both US and non-US have a good quarter. And then EM, you got 9.3 versus 11.2. We're looking at the benchmark for that. Vanguard every once in a while changes their benchmarks. I think there's a FTSE EM China A shares index, which I believe they've shifted to. So we're just going to double check that. So instead of it, being 9.3 versus 11.2, I think this quarter was 10 point something. So they change things around. We just need to update it as they change things, but that's gotten you EM exposure, obviously at a cheap price. Getting your alternatives, real estate, you can see principal real estate was negative 0.2. So you see those negative numbers shrinking, which is obviously what we want to get to. I saw their October number released. They actually had a slightly positive number. So we're starting to kind of see some positive bumps up there. And you look at your real estate through time. Obviously real estate, pretty much every client has bemoaned real estate for the past couple of years. But you go back in time, let's just say the 10 years, you've gotten 5.7. That's outpaced the general non-US equity index, as well as your returns. It's pretty much doubled fixed income. So still think it has a place in a portfolio. But one of the things obviously we talked about was maybe just shrinking that eventually and backfilling that with something like your private equity, which is you've had since February 2022. So it's been a little more quiet in private equity in the recent year, 2 years or so at this point. But starting to see exits and discussions of exits, and it sounds like with obviously the new administration coming in, a lot of folks we talked to in private equity world seem a little more excited about the potentials for them to do what they need to do. You look at the benchmark for this particular fund going back in time, 5 years, 7 year, 10-year annualized, and that low to mid teens. That would be our expectations for this fund in the long run once you kind of get through the bottom of this cycle. And then cash, you see cash returns obviously have been historically high, and obviously as the Fed has cut and cut again, any excess cash is going to start earning less on that sooner than later.
Go back to the principal. That's private real estate, right?
Yes.
And is it
Is
kind of a 90-day lag too, or is it real time similar to Partners Group, or like similar
principal's monthly value. So they're
public REITs are doing well this year.
They are. So you kind of look at you're probably thinking historically, you look at REITs, private might follow and vice versa to kind of see how things, but yeah, public REITs have definitely come back.
We still have our sell orders.
You do.
for that.
And Jonathan's going to give a little update on that in a
okay.
second, just so you kind of know where that sits and you kind of game plan. So then you got historical information. And then if you jump for the minutes, maybe page 21, and then Jonathan will cover kind of the rebalance and update on principal. So page 21 shows you asset class, investment manager, the fee schedules are, then, you know, we estimate what that means in a dollar standpoint for the year. So estimating with the current market values, just shy of $90,000 annually for all the investment managers. So 89,648. So that's about 38 basis points, and industry median of those is 37. So obviously you have a mix of some passive and some active. So you're kind of right at industry median based on that. Some of these, I'm guessing some of these are going to be a little higher than others. Some of them are lower. But at the end of the day, the mix is what matters, and that's good. You have RFE, then you have regions. You switched over a few years ago from a custody standpoint. You see their fee on there as well. Any questions on that part of quarterly? And I'm guessing October, based on what I've seen, most clients are kind of down somewhere between 1.5% to 2%.
Yeah.
So far November, obviously today was down a little bit, but so far November, it's basically erased all that and then some. So we'll see if that holds. Okay, Exhibit 2 runs through kind of where we're at, and Jonathan will
Yeah.
cover that.
Yeah, if you all can flip to exhibit 2 if you haven't already. This is your rebalance sheet. First, I'll give you a quick update on the principal real estate redemption that you currently have in. So we upped that in May by another 500,000 to bring the total to $1 million. Currently, you have about $720,000 remaining in that redemption. And I'll give you a quick update. Recently, you did receive 77,000 from them back in October on the 15th. Based on current values, let's say we were able to take all that out today. That would bring real estate back down to about 6%, well within your guidelines still. Seems that the gates overall are kind of inching open after not really being able to get out much for about a year and a half or so. And we do hear that they are kind of excited that as rates come down, they're kind of gonna expect that real estate should come back. Overall, looking at the incoming queue they have versus the outgoing queue, which is what you're in, they have 300 million in the incoming queue. They have 1.1 billion in the outcoming queue. And just to give you some perspective on that, that's 14.8% of net asset value for the whole fund. So that's why they're not, super eager to pay all that out all at once. But that is down from where they started at the beginning of the year, which was 1.4 billion. So it's getting better. It's improving. And overall, you do see, just to get back to the rebalance portion of this page, there's a column in the middle there that says suggested changes. So as Tom mentioned, you pay benefits out of that principal core fixed income account. So we are going to recommend that you all pull from some other assets to kind of replenish that account. So as you go down the page, we're going to recommend 500,000 go to the principal core fixed income account. And where we're going to recommend we take that from is starting at the very top. With the Vanguard S&P 500 fund, we're going to recommend we pull 230,000 from that account, then 100,000 from the Vanguard mid cap account, which is just below that one, then 50,000 from the Vanguard Total International fund, and then 50,000 from the Vanguard Emerging Markets fund. And then at the very bottom there, you see there's this little line that says Fidelity Cash. That's the money market fund that you all have at Regions Bank. As I said, we received that money earlier last month from Principal, so we're going to recommend pretty much putting most of that to work. So 70,000 out of that account to Principal core fixed income as well. So that's the recommendation. We'll just need your approval to draft up some letters and get that moving.
That 500,000 has kind of been consistent. Well, been raising it 5 to 600,000 depends on.
Motion.
Yeah, I guess we need a motion before we discuss. Let's make a motion to go forward with the recommended changes that are being the allocation. Thank you. The reallocation of assets as proposed. Please.
Second.
Mike, second. All right. Discussion, questions they have? Anybody? Anything? All right. All in favor? Any opposed? Excellent. All right. You're good to go on that.
And just in general, on the asset allocation, real estate, private equity and all that. So, we kind of talked about aspirationally getting that real estate maybe like 7.5%. And then eventually getting up, the partners group to, well, 7.5 to 10% or somewhere in there. So as things loosen up more, we can like have serious conversations about that. But obviously if they're paying 50 or 70,000 a quarter, still gonna be a little bit.
Yeah, let's hope the floodgates open up a little wider.
I don't see that happening too soon.
Do y'all have any other private equity suggestions?
I mean, we have a variety. So right now, obviously you're in kind of evergreen
Mhm.
open-end funds. I recently placed someone with Pantheon. We have a longer, probably not, but yeah, longer track record. Also just of diversified exposures across all the different flavors. More are coming on. So, private credit, and we kind of talked about that a little bit. I don't know if we're gonna get too cute with that, but the amount of evergreen funds in that space are obviously exploding as well. So yeah, there are other options out there. Partners Group tends to kind of be the easy button to kind of get exposure quickly. But yeah, there are definitely others out there.
Other questions?
And I guess just the next page, just so you can kind of see similar topic, just on kind of where benefit index sits at. So as always, we get this spreadsheet, we update it and we try to play around with, okay, what if we get rid of half the real estate? What does that do to the cushion? Or what if high yield able to move that out? So your cushion right now is about 1.3 million. So if you were to, let's say, remove high yield, that gets you down to about 500,000. And then obviously real estate, as that continues to come down, that's at a liquidity volatility factor of 0.65, so that won't hit you as hard. But obviously just keep an eye on that. And, I know the goal's been to various time periods, you've had different targets on that. And obviously you've de-risked this part of your portfolio. But obviously just always being mindful of that.
Questions? If we, with the move we're doing currently, is that after we do the 500,000? Because isn't the 500 going from regions to principal?
Yeah, so that would bump up.
So we're at 1.3.
So you'd be
Currently
1.8.
now we're 1.8.
You'll be 1.8. Yeah.
Okay. Even though that's gonna have to, that comes out.
And it'll
pretty
be,
soon.
in and out.
Yeah, okay, that's what I thought.
Yeah.
Okay. All right, other questions, anything? All right, next on the agenda.
Exhibit 3, come here hat in hand, to request consideration for adjusting our fee. Kind of background, back in 2006, Marquette, formerly known as Fiduciary, started and didn't ask for a fee increase till 2021, quite a long time. And the terms for that were 3 years on that. So that expired back in December of last year. So as a firm, we're just kind of trying to do a better job of going through expired contracts and getting a handle on that. So obviously our costs go up, and as talking to Alan, we have limits on our ability to, I can't take on 40 clients. He can't do 40 clients. So we have scale on there. So our request is for the consideration going from 36,000 annually, which is your current fee, next year up to 38, and then to 40, then to 42 over the subsequent years. So basically $500 a quarter on there. So I will shut up. Appreciate your consideration. Question?
Consider it.
Okay, that's fair. That's all you want. So I think, if you consider it and think it's okay, I guess it would have to be recommended to council, and then council would have the final. Say.
I guess at some point in time, I'd like to see it get to a percentage that maybe where we are right now.
Mhm.
But that if the value of what the account is that fee would not go up. But it could go up as long as the value of the account goes up.
Yeah, I have a client that is kind of in terminal decline. We'll just say
What?
that, in terminal decline.
Okay,
Like the expectations are that it's going to be done in 10 years. So we've been ratcheting our fee appropriately, just because obviously that's not fair to them. So obviously we're mindful of that, not saying that you
Okay.
are in that situation at all. I'm not saying that. But
I just want to throw that out for the
Alan and I
future.
disagree on that point.
Right.
okay.
So I'll just throw that out.
Yeah, I mean,
It's-
Ted has no problem spending the city's money.
No, I don't want to go on, I don't want to go on a percent of assets.
Yeah,
But
so we're talking,
But you know what I'm saying is I just don't want, at some point in time, enough is enough if our fund is not going up proportionally.
yes.
I would move that we accept the fee schedule as.
Well, I think we ought to have a discussion after we finish this. I'd prefer to do that.
Yeah, we can leave.
Okay,
That would be my
you
preference.
want to leave now?
No, I want to finish that. They presented that and we appreciate their presentation because it's got to, it's not our decision anyway. It's got to go to the city council.
Yeah.
So it's not like we can, if we say yes, it doesn't mean it's going to happen. So
Yeah.
It's, you understand these things.
Yes, I do.
Yes, you deal with enough of these municipalities and everything else. Right.
Questions?
Is there any other questions for them about
Do you have any questions?
any of the three topics we discussed? No? Okay. All right. Thank you, guys.
Thank you.
Appreciate
We
it.
really appreciate it.
No, we appreciate and
Do you have an
What's the-
estimate for when you want the next meeting?
Well, I think the next, we'll do the same cycle.
yeah, this one, yeah, thank
This was
you.
just off.
This
So
was a
we do
mo-
it the
this is-
first, oh, I'm
So
sorry.
When will it be? Do you know what that date is?
Oh,
So we can put it on everybody's.
it's
calendar.
whatever. It's the first Thursday in February.
Yeah. First Thursday in February.
Correct.
First Thursday. Is that after you guys are in town or is that before you guys are in town for your presentation? Or your full deal, breakfast deal,
I think it's the day before.
day before? Okay,
I think it's February 6th, if I'm,
Yeah.
February 5th, sorry. February 5th is our market preview
Okay.
at Cheshire, and then
Got it.
yeah, 6th,
Okay.
yeah, February 6th is the meeting date.
Okay.
Right, 5 p.m. And this one, thank you for moving this. This is my November where
You gave us enough time, so this
I'm
was,
in 3 places at once at this November meeting, so.
and the only problem was I thought I had it wrong in the schedule.
So did I. I was like, last week, I'm like, we haven't got anything. And I realized I have that on my calendar both places.
Yeah. so, no, that works if we have enough time.
Okay, February 6th is our meeting.
February 5th, you'll get, if you haven't, or I don't even know if we sent those out yet.
I think they're getting
our
ready.
Breakfast and all that, so you'll
Okay.
get that.
Awesome.
While we're looking at the calendar, May would be on the first. Does that give you enough time in 25?
To get a report generated.
We
It's
have,
the first-
30 days. I mean, that, our numbers are.
Post, yeah, it's like.
So
30
they've
days
got
before.
30 days, so. I hope
Yeah,
so.
that'd be okay.
Yeah.
Yeah.
Thanks for asking.
Yes. That's why we did it the month following.
Yeah,
Gives you at
so
least
it's
30
just
days to.
not-
You have some that like cut
Appreciate
it
it.
real close and then there's the.
Yeah.
Can we or can't we?
Can,
Yes.
can this is not meant to be funny, but it's somewhat. Are any of the other municipalities putting Bitcoin into their portfolios?
Not meant to be funny. None that I work with, I'd say firm wide, and this would be nonprofits that have less oversight too, of course.
Uh-huh.
There's maybe 4 or 5 firm wide that have done that. What they've done and how to do that kind of thing is kind of outside of the investment policy. Because obviously, if we try to, we say, okay, we'll put 5% in Bitcoin or something else. Like, there's no real way to model that like accurately. So it's just like, okay, you want to put that on the side, kind of put it in its own account. And there's more and more custodians are adopting it. So
Right.
it's 5 years ago, we'd be like, it's not really feasible. But now it's doable. But from like municipalities,
Iffy.
Can RIAs even, I haven't filed this because we don't have it, but
Yeah.
can RIAs get compensated for Bitcoin? Like advising? I thought it was still against SEC policy.
I mean, So so they would just basically, the board would buy it themselves. So they'd say, okay, we are doing this, we are directing, give us bids on different places where you can do custody at, and then you would do the transact, like a Fidelity, something like that, like they're actually pretty forward on that kind of stuff. That's kind of how they're getting around
The
that.
liability would be.
Yeah, I mean, yeah, I think there's some public plans and larger ones in Michigan that are kind of all over the board on doing some pretty creative things, which may or may not work, not our clients, but out there, but you're seeing it more, certainly not at an mass adoption level yet, but
That's all, I just wanted to. get
private
out.
equity, you're able to get into buy sports teams. I mean, there's going to be more options of different ways to invest, however you want to spend your money, people will find ways to take it.
Very true.
Okay.
All right. Thank you,
Okay.
guys.
All right, thanks.
We appreciate it.
Everyone.
Thank you.
Michelle. All right. So we used to have meetings when I came on, it was probably about 10 years ago. They would sort of email, and say, okay, when should we have our next meeting? And when I took over, I said, okay, we need to, every other committee probably in this meets regimentally. And it was like, why aren't we doing that? So
No,
that's why.
I appreciate that. I just want them to say it out loud.
Oh, okay. That's fine. I get it. I understand the method of your madness. All right, so let's talk about what they're doing or their proposal. Does anybody have any start the discussion, comments? I know you said you wanted them to go to eventually, but
Well, I
Yeah, tell me.
don't, so, and Darren's not here, but, oh, yes, he is. So Darren sent something out that showed that, I can only see his head from here. Darren said that they, in his thing, he said that their minimum fee for bringing on new clients is $75,000. So my expectation is that, well, if that's what they're trying to do, then obviously we're not going to fit in the ballpark as time goes by. So, if it gets up to a certain point, I don't want it to get above like 50 basis points or whatever, 35, whatever
We're
it is.
close to, it's at 15 basis points now, and this would get them still shy of 20 basis points.
But I think that there should be a cap on that, especially if our asset level goes down. That's all I'm saying.
Yep.
That's my comment.
Or are you opposed to a basis point, a fee of assets?
well, if we keep, I shouldn't say I'm opposed to it. I just think that if we are, I mean, I understand I'm a proponent of an asset charge. But hopefully if we grow, I mean, when they increased their fee, we were at 25 million. And now we're at 23 million.
In crazy bull market.
Yeah. Obviously, if we do that, we stop these conversations. But, yeah, are the assets gonna continue to decline or are they gonna go up? It's rhetorical. But if we continue to go up, at 30,000, if we could get to 30 million, if I'm just making that up, it just increases your fees. So, I shouldn't have said I'm opponent because I'm not an opponent. I don't know.
I don't know that they would be open to
Yeah.
a basis point fee, just because of what Jennifer mentioned, and it's clearly a descending plan, so there will almost be a fee decrease that they would be proposing.
Yeah. So I mean, I always look at, are they doing any more work? They might, the fact that they have internal increased costs and all that kind of stuff is not my concern.
That's my comment.
Yeah, no, I know. That's not my concern. The fact that the assets are $2 million less than they were when they increased the fees the last time, and they want to increase them again.
Yeah, but I think one of the problems you have with something like this is it doesn't matter how big your fund is, they're doing the same amount of work. If we had $5 million in this thing, they would still be doing the same thing and they'd be asking for that same amount. I mean, that, if this thing was 40 million, there's a certain factor that they're trying to run a business and they're trying to make money off of. And to me, when I see these numbers, I'm actually kind of surprised that all this costs to do that. So, I mean, in reference again, like I said, if you have a $5 million or $35 million, these guys are doing the same work. Nothing's really changing.
The difference is the risk.
Well,
And it's added risk for bad trades or things that happen. That's what that's also,
on
the
a
increase.
percentage basis, it's not, for us, it's the same. We're losing 10% or 20%. And
Mhm.
so for them, with a small fund, they just, when it's a percentage base, they don't have a lot of opportunity there to make that money. So,
And we could always make a proposal that, or counter to them and say that we keep it at 10.5 through 2030. So there's no fee increases.
Yep.
They're gonna increase it every year through 27. We can say it stays at 10.5 through.
And so I'm new to this. I mean, our factor is one thing. We say, well, we're not gonna pay them more money to do the service. Our other option is to leave and go somewhere else, right? Is that,
This is
am
what I
I,
was gonna ask, what's
you
the
know.
alternative, or if we don't define, do they
I could,
deprioritize us and stuff?
the last time we went through this, and we ended up hiring them, I think it goes back, I don't know how long ago, when they say they started 06. I mean, that was after we had some significant down years, but if I remember correctly, Darren, how many? We didn't have more than about 2 or 3 people that were willing to even look at the fund. We put it out for bid.
There's a little bit more history to that. I mean, the reason they didn't ask for any increases for that time period, if you go back and look, there's horrible, you were there.
I was there towards.
Yes,
came in the
I
middle
mean,
of it.
most of you were, Jeff Lapidus was kind of leading a little bit through that. The board went against the advisors' advice and left it playing in a bad shape for a long time, 10 years. That's why they didn't ask for any fees.
I mean, I can speak to, if you put out for RFP right now and you just said
Yeah.
that they won't take anybody for less than 75,000, I mean, 15 basis points, nobody's gonna touch, I mean. That's a
That's
very
what I was hoping we
competitive.
get out of this today. So when was the last time we went for RFP and asked? It was about 2006.
Yeah, probably.
And so, yeah, if you never know what you're gonna get when you ask sometimes. And so this is what.
I mean,
oh,
they're,
This,
as Mike said, they're very inexpensive. I mean, 15 basis points is
Sure.
really cheap.
and to Ken's point, the work is the work, but the risk is also increases every time. This is not some of that benefit index is a little bit of a hairy beast to understand. Now, we can get it. But it's a little unique
I sort of like
to manage it.
Yeah, I like Mike's idea and say, look, we'll do this, but let's level it from 27 to 30.
Lock it in long. So,
Or,
something like
you know,
lock
or
it
they
in long.
they might come back and say, 500 each year. Or was it 2,000 each year, I guess?
It's 2,000 each year for 3 years, so bringing up $6,000. Right?
I mean, yeah, and in the whole scheme of things, if you're talking about a $23 million fund, it's pennies.
Yeah, it seems like nothing.
Yeah.
Sorry.
No,
But-
it is, but
It
also think about the amount of work they're doing.
Yeah.
You guys, you two can comment more so on the amount of work they're doing.
But it's also, as I said, it's risk too. They screw up and they have to make something right. They make a bad trade and all of a sudden they have to come up with $50,000 to make it right. That's their annual fee.
Right.
So
I'm sure they have.
they have insurance, but what's the deductible? What's the deductible on the insurance? So anyway, I'm not making, but that's part of the game. I mean, Yeah.
It's risk they've been willing to take for a while.
Yeah.
And that's the other part is, and they're
Well-
continuing to for just a little bit more or
Well,
maybe a little bit less.
when did he join? When did he basically merge with Marquette? I mean, that's the other thing. They've now gone from a smaller
Yeah.
operation to a much larger operation.
And that's what I was kind of
Yeah.
went through in my head. It was about 10 years. It was right after I kind of started, they were using the Marquette logo, but Fiduciary Consultants was still around. Brian had made that decision to move over. Yeah, I mean, they're part of a bigger beast and they got more overhead than. they
That's
used
what
to.
happens.
And it does. And they
Happens every
switched to
time.
new software. I didn't decide to switch to new software.
Yeah.
They did. And it's probably
Right.
more expensive than the one that you were using before.
Right.
Of course.
more
But either way,
efficient, more-
again, not,
Yeah.
not my business to,
I mean, technology is changing, so it's making their job easier, not hard.
yeah. Maybe Jeremy works for more than Tom used to when Brian was here.
All right, so what should we, Jennifer? anything?
So what I need from you is a recommendation to the council, or if you want to counter Marquette and see what they say. But then you'd have to come back and have another,
Well, we could probably do a motion that if they accept our counter, we can go to the council.
yes.
What do you guys think? Please.
So my only reservations, I feel like we're.
Can you turn your mic on?
I was-
'Cause
sorry.
I can't hear.
Okay, I was saying one of my reservations is I feel like we're trying to control something multiple years out, obviously 27 to 30. And maybe our portfolio is growing leaps and bounds by then and it's, turned. And I don't know, it could be new people on this board, like, micromanage, for the lack of a better term, a little bit, the future. When we also don't know what that is. It doesn't mean I'm opposed at all. This is a space I'm not as familiar in with these fees anyway. So that's more just a comment, is they're gonna come back to us. Again, it seems like they don't just raise their fees, they come ask us permission to raise their fees.
Sure.
And so in 2027, if they are gonna raise them again, even if we have agreed they shouldn't and they want to, they can come back and ask us again. I don't know, just
So
kind of throwing out that comment.
It's a great point. What is the, our board member have any comment?
That
No,
statement was that statement to me was just fine. I mean, you're
Yeah.
right. They come back, they're gonna come back in 3 years. We can say yes or no at that point in time.
Mhm.
I mean, if we want to say, let's take this out to 2030. And they want to say, they want to guarantee no increases for another year, that's fine too, if they're willing to take that and do
Right.
that, but. The way you just said it is fine as well. We have the option in 3 years to say no. We're not locking in anything. And we were kind of forcing their hand to say, listen, we're not gonna raise our fees unknowingly in X number of years. That's a long time to say you're not changing anything, I think.
yeah, it's fair. It's fair.
So
Who's
I would be
our-
comfortable with saying, doing that and, obviously you renegotiate then at that point in time.
The board advisor. So
Greg, do you have any?
Greg, do you have a comment?
You're muted.
You're muted, Greg.
I kind of like the idea of doing a counter offer and see what they say. So,
Of locking in for a longer term or just doing a
Yes.
counter offer on what they gave us?
well, no, and if we can lock in for a longer term. So I think that would be good. It gives you a known entity as opposed to, Yeah.
What's your counter suggestion then? Are you suggesting nothing then after 27 to 30, like was mentioned before? Or do you have some other number that you're comfortable with?
no, I don't have any particular number. I'm not well versed in what the fees are in these at this level. So exactly what how much is typical, but I just think when you can make certain your cost, that's one thing you can control. So more so than the market. So you may prevent yourself from some sort of inflation at that point of their costs. I don't know. So
All right, well, then we'll have to come up with some sort of counter then. Anybody got any suggestions?
2 counters would be to basically say, lock it in till 30 after we get up there to 27. Another thing we could do is we could say, let's have an increase each year of $1,000 fee or $250 a quarter until 2030, assuming that our market balance doesn't go down.
I think that gets a little hairy.
Yeah, the latter part. I'm not
Well,
saying.
no, I'm
yeah,
just saying, let's
Okay.
just say, if the fee if the market value of our account doesn't go down below where it is today after 2027, and we'll continue to pay that. And
Well, then if that's the case, I'm just saying that I think we don't counter, we just accept what they have and do what Ken said and just.
Yeah,
And
I feel like you're,
what you said, that, just we'll deal with it at 2027. They come back and say, we want to increase your fees. We say, no.
Well, and there's something to be said, like, if we disagree to this, how often do they look at, like, I don't know the right answer to this, but if we put a date of 2030, is there gonna be a trigger, a reminder to go, oh, at 2030, we need to come back and renegotiate? Where if we disagree to this now, will they not come back for another 6, 7 years after 2027 because they don't have a date that tells them they need to come back to renegotiate? You know what I'm saying? I don't know the answer to that, but it seems like because
and
prior to this one, when is the last time that they raised?
2021, or before that was, they hadn't.
2006 to 2021.
2021. So even
Same.
2021 to 2024, or really 2025, we're at 4 years where they just ignored
They
it,
let it
basically.
expire.
Yeah. And so by us setting a deadline, like me, if I had a deadline, it'd be on my calendar that I need to look this up and we need to renegotiate and get a plan after the date they told me, at 2030. Whereas if there is no date, then they can they can negotiate at any time, no
Sure.
matter what. But
So,
I'm being devil's advocate.
no, I, Richard's saying, so I
And
think,
then the question becomes, what drove it to this point where they're now coming back with this? It's because someone went to them and said, hey, we'd like to have a raise. And they said, well, you haven't raised your fees with your clients. Because he said he had a limited number of clients. He said, I think he had 14 clients. So obviously, if he's got 14 clients, that means he's got
it was 40 something, I think.
okay.
Anyway,
sorry.
but that's okay. But anyway, all right. So I think, I kind of agree with what you guys are saying and so I'll make a motion that we accept the proposal that regarding the fees, and we will let who's ever on the committee in 2027 or therefore let them come back, and if they want to raise them at that time, they can propose. What
They are.
what they've done, what they did. Yeah.
We give it to them.
Yes.
For 3 years.
Yes, and then whatever they do after that is, they can come back and we can just deny it if we don't want to do it. Yeah. So that's my proposal. Do I have a second?
Yeah, second.
All right, is there discussion? Hey, we can vote against it. I'm not, I'm not saying that's the right thing to do, but
Yeah,
So-
did you have a different counter thought or counter proposal that you wanted to bring up?
I think, for me,
Mhm.
when I'm doing contract, I always negotiate the price. Maybe 1,000, what Alan said, and see if they will agree for 3 years. Because 200 is a lot of money.
2,000.
Yeah, 2,000. 3 years, you're paying 40,000 a year, right?
in the, 2026, you're paying
42,000.
Yeah.
Yep, 42,000.
Goes to 42,000 a year.
see, and I look at it as a total. If we're paying $40,000 on 23 million, I think we're getting a pretty good deal. That's just my opinion do you
I agree.
agree? Yeah, that's, I'm looking at it as the whole, that we've gotten a pretty good deal through the years and
Yeah. So
now
the
they're
other-
coming back to the table.
Yeah, I was gonna say the other page that talks about, they don't share,
They don't share on their own fee what the.
what the industry median is, right? But
I
I mean,
here.
I can speak to that. I mean, it's
0.50%.
no less than 20 to 25 basis
Yeah.
points.
I agree with that.
I mean,
0.50
Plan Corp
total.
won't come to the
This is,
table for less
the-
than 20, and Moneto is higher than that. So
Are you talking about institutional, or are you talking about, are you talking about?
for
Yeah.
endowments, yeah.
for
Yeah.
endowments? Well, endowments pay a higher rate than
Right.
I think municipalities do.
That I can't.
Okay.
Even still.
Yeah, they're saying even here.
I should check with someone.
That's what I'm saying. I think we got a pretty good deal. going.
37 on the fund.
So, all right, any other discussion that we have?
Fees.
Since there's a motion on the table?
No.
Any other discussion? All right, all in favor?
Aye.
Any opposed? Any abstentions? All right, we're good.
Do we have anything for new business? We don't,
There's not a new business on here, but does anybody have anything else they'd like to discuss, or new business, old business?
I'm just curious because it's been a while that we've had an update just on like what's happening in the city. Is there anyone can speak to that?
Oh, we'll do that after the meeting.
After we adjourn. Okay.
Yes, yes.
but the one thing I would like to bring up is that I think at some point in time, we need to look at the cash flow. Because we're talking about if we need to raise money, to have more money to be invested in order to continue to make the payouts out of the funds.
Mm-hmm.
I think we should look at other because I know at one point in time there was a specific tax that we'd taken up to a certain level. I think we've maxed that out, and I don't know if the city has to raise that up again in order to basically deal with this.
So you're talking about the pension property tax?
Yes,
And if the city were to raise it, it would have to go back to the voters. And I don't know what our capacity to raise it is. We'd have to do some math, but it would have to go back to the voters.
okay, I think it's something that's worth looking at to make sure that we are on solid footing. I don't like anybody saying that other cities are in worse shape than we are. Because we have to worry about ourselves. And that's my feeling about it.
We can get you some information for the next meeting.
For the committee.
Yeah, for the committee. Yeah, for everyone. Not just you, for everybody. We share with everybody.
All right. Anything else? Motion to adjourn.
Second.
Beautiful. Meeting adjourned.
Great.
All right. Okay.